For more on market risks tied to the disappointing consumer sentiment data, let's bring in CNBC contributor Peter Boockvar, Chief Investment Officer at Bleakley Financial Group. Peter, great to have you with us.
Hi, Melissa.
Before we get to all that, I want to talk to you about a headline that crossed in just the past half hour or so. We learned that the U.S.'s last AAA rating is gone. Moody's has downgraded the U.S. To a AA1 from a AAA. The outlook is stable. What does that mean, if anything, to you, Peter?
So Moody's is following S&P 14 years later. Obviously, Fitch did it as well. I don't necessarily think that there's much of it. Treasuries are still dealing, though, with the fundamental factor of less foreign demand for them and the growing size of the pile of debt that needs to be constantly refinanced is not going to change. But it is symbolic in the sense of here's a major rating agency that's calling out the U.S.'s strained debts and deficits. And I don't know if that's enough to sort of change the negotiations currently right now in Washington. I think more impactful would be if the 10-year yield really started to spike, sort of like what we saw in the UK a couple of years ago. But I don't think we should ignore it. But on the other hand, I don't know how much of an impact it's going to have on the actual levels right now in the 10-year, for example, with that being the benchmark.
All right, let's get to the consumer and to markets, Peter. You missed survey, it's soft data. The Fed has sort of discounted soft data, relies on hard data. But how important do you think this is, this unexpectedly weak reading? You say that it's a bipartisan issue. How does that then factor into how we handle tariff negotiations?
Well, it's clear and loud and clear from that survey that consumers are really worried about the inflationary impact from tariffs. Whether it's a one-time thing or not, I think a lot of consumers, particularly lower to middle income ones, still have PTSD from 2022 and 2023. And the last thing they want to see is another rise in their cost of living. And that Walmart, I mean, when Walmart gets to dictate what they want to pay a vendor for a particular product that's sold in their store. And if one vendor is selling something too much or too high, then Walmart's going to go somewhere else. That Walmart is acknowledging that they have to absorb the price increases coming from their vendors, I think is pretty notable. Now, to what extent prices are going to go up, so there'll be some products and not others, but I think that they can't fully absorb these tariffs is a pretty telling thing. And over the next couple of months, you're going to see a lot more of that. And I'm really interested in next week to hear from the slew of retailers that are reporting to see what extent they're going to pass it through. But regardless of whether a retailer is going to pass it on to us or not, it's going to be eaten somewhere along the supply chain. So somebody's going to get hurt by this.
Hey, Peter, it's Courtney here. I found it really interesting looking at those consumer sentiment numbers. The consumers are clearly very concerned about tariffs. But what happens when we get past this? And are we at some point going to focus on things like tax cuts, things like deregulation, things that may be positive for the economy? How quickly could you see some of those numbers turn theoretically? And what does that mean for the consumer sentiment numbers or the economy at large moving forward?
Well, I hope so, Courtney. I hope that we can sort of change the conversation from tariffs. But let's just take what would be the best case scenario on tariffs, and that all we have is 10%. On top of what was the existing tariff rate coming into the year at about 2.5%. So even at that best case rate, we're still going to have the highest tariff rate since the early 1940s. And just to put a dollar around that, a 10% tariff on $3.3 trillion of U.S. goods imports, call it around $330 billion tax on U.S. companies. Well, for perspective, U.S. corporate income tax receipts are about $525 billion. So if you add those two together, you divide by the pre-tax income that is implied by a 21% corporate tax rate and the 525, then you're essentially raising the effective corporate income tax rate to 34%. So that base case 10% tariff is essentially wiping out, back of the envelope math, the entire Trump corporate tax cut in 2017.